In this video, I'm going to explain everything you need to know about dividends and how they're taxed so you can become a better investor. Get ready to smash that piggy bank and start putting some money into dividend paying companies. What's up everyone? Welcome back to the channel. And if you're new here, welcome. My name is Johan Lorenzo, and in this channel, I help people improve their finances and build their wealth in the stock market. If that's something you want to be a part of, make sure to subscribe, hit the notification bell so you're notified every time I post a new video. With all that said, let's get into it. What is a dividend? Think of a dividend as thank you money. The company you own shares of will thank you for investing in them by giving you a piece of their earnings. The payment they're giving you is what is called a dividend. That dividend will be placed in the buying power of your account, or it will be automatically reinvested into the same company if you have a DRIP set up in your portfolio. A DRIP stands for Dividend Reinvestment Plan. When activated, it will automatically reinvest the dividend payments from all of your companies back into themselves, resulting in you buying more shares of those companies. Back in the day, this was very attractive because brokerage accounts used to have commission fees. I used to pay $4.99 every time I wanted to purchase shares of a company. Whether it was 1 share or 100 shares, I had to pay $4.99 every single time. And that same fee applied to when selling the shares. So back then, having a DRIP in place would give me the opportunity to buy more shares of these companies in my portfolio without having to pay $5 in commission fees every single time. Imagine owning shares of 20 different companies and consistently buying shares of those companies. Those $5 fees start to add up pretty quick. Now, I personally don't use the DRIP anymore. Nowadays, not having to pay any commission fees, I prefer to leave that dividend money in my buying power for when a deal in the market comes along, I can take full advantage of it. I feel that gives my dividend payments an even bigger bang for their buck. But if you're new to investing, having a DRIP in place could still be a great thing for you. What is dividend yield? When you want to know how much a company pays in dividends, look at the dividend yield. The dividend yield is shown as a percentage which is relative to a stock price. So what this means is, whatever the stock price is at the moment, you will get paid X% of that stock price as a dividend. If a company's stock is at $100 and the dividend yield shows 2%, it is telling you the company is paying you 2% worth of $100. So that would be $2 per share per year. If it's a quarterly paying company, that $2 payment will be divided by 4. So you would be getting paid 50 cents a share 4 times a year. Quarterly dividend payments are the most common for companies in the US. What is the declaration date? Also known as the announcement date. This is the date the company announces how much dividend they're going to pay for their next rotation. You'll know if they increased their dividend, maintained it, lowered it, or even cut it, worst case scenario. The ex-dividend date. You need to own shares of the stock before this date to get paid. If you buy them on the day listed or after, you will not get paid for that upcoming dividend. You will have to wait until the next rotation to collect the dividend. The pay date. Show me the money, baby. This is when the dividend is set to be paid to shareholders who purchase the stock before the ex-dividend date. When are dividends paid? Well, in the US, most dividend companies will pay their dividends quarterly, basically every 3 months, which will come out to 4 payments a year. If you see a company that says they pay a $4 per share dividend, this means you will receive $1 per share 4 times a year. You also have companies that pay semi-annually, which is every 6 months, and some that pay annually, once a year. Then you have REITs that can pay you monthly. REIT stands for Real Estate Investment Trust. A REIT is a company that owns income-producing real estate, ranging anywhere from healthcare facilities, malls, hotels, office and apartment buildings. REITs are an easy way for investors to get exposure to real estate through the stock market. Although it is awesome to get paid monthly by these companies, you have to remember, the income you receive from a REIT is taxed way different than that of a regular stock. A REIT is taxed as ordinary income, so depending on the tax bracket you fall in, that's the percentage you'll pay for these dividends received. Speaking of taxes, there are 2 ways dividends get taxed: qualified dividends and unqualified dividends. Qualified dividends will get you the better tax rate, the same tax rate as long-term capital gains tax. I'll explain long-term capital gains tax in just a second. To be considered a qualified dividend, you must own the stock for 60 days before the ex-dividend date, and it must be paid by a US company or a qualified foreign corporation. On the other hand, unqualified dividends will be taxed at your regular income tax rate. Since you did not own the stock for 60 days prior to the ex-dividend date, that is the price you pay.
Literally.
Regardless of whether you reinvest your dividends or take the cash to pay your bills, you will pay taxes on those dividends. The amount of taxes you pay just depends on whether or not it's a qualified or unqualified dividend. You've probably heard the term capital gains. Well, here's a quick breakdown. There are short-term capital gains and long-term capital gains. Short-term capital gains are when you own a stock for 1 year or less and you sell it. You will have to pay tax on those gains as if it were your regular income tax rate. So once again, depending on which tax bracket you fall in, will decide how much tax you pay on these gains. Speaking of tax brackets, there are currently 7 federal tax brackets in the US, ranging with rates anywhere from 10% all the way to 37%. Long-term capital gains. When you own a stock for more than 1 year and sell it, you will pay a long-term capital gains tax, which is composed of 3 different tiers: 0%, 15%, and 20%. These are the same tiers as qualified dividends. So for example, let's say you made $1 million working a job on a salary. You will pay an income tax rate of 37% on that money, $370,000. Now, if you made $1 million in a year collecting dividends, you will pay a maximum tax rate of 20% on that dividend income, $200,000. That is a $170,000 difference. A very important side note, dividends are not guaranteed. A company does not have to pay you a dividend. A company can cut their dividend or eliminate it completely if they run into financial troubles. It is crucial you do your research on the dividend stock you're looking to invest in. This way you can minimize the chances of investing in a company that's at risk of cutting their dividend. I'll be making a video soon on what key points I look for in picking dividend stocks. Oh, and also, smash the like button for your boy. Feel free to leave me a comment down below. Let me know if you're already a dividend investor or looking to get started with picking your own individual companies. I would love to hear what you guys are up to in the market. Don't forget to grab your free stocks from Webull and Robinhood if you haven't done so already. I'll leave the links down in the description below for you guys. Thank you guys so much for watching. I appreciate every single one of you. Until next time, peace!